It is. Yeah, alright, so first one, stock at cost was 75.4. So that's the closing stock working. So it starts off 75.4. It includes damaged stock, which costs 6,000 now is net realisable value of 75% of cost. So take away the 6,000 and add on 75% of 6,000, which would be 4,500. I presume the fact that it has a percentage rather than a number doesn't cause any confusion to anyone, does it? Alright. Okay, so secondly then, we've seen this one before. During the year, stock which had cost 7,000 was destroyed by fire. The insurance company agreed to pay compensation of 5,100. So when stock is destroyed by fire, it doesn't change stock. Well, it does change stock, it's just not counted. You can't obviously count stock that's not there. So stock is valued by counting it all up on the last day of the year. So it doesn't change stock, so it changes purchases. Because it's purchases for resale. If the stock is destroyed by fire, it can't be resold. So that's why it changes purchases. So we go up and check our question. Purchases starts off as 1045. You don't have the stock anymore that was destroyed by the fire. So we take away the 7,000. Okay, and that's all we do with that. Then you make a note. Now I wouldn't write this in. If I had the skeleton drawn out, I would just put in that 5,100 into insurance claim due. You don't have to put it in the workings. You can put it straight in. But I'm not doing it that way. So insurance claim due is 5,100. It could go straight in, said if you had the skeleton drawn out.
Where do you put that?
It's a current asset, so it's money that's owed to us. All right. The third part then is the difference between the two of them is a loss on the insurance claim. It's not really a loss on the insurance claim, it's more of a loss on the fire. But it's 1,900, which is the difference between the 7,000 and the 5,1.
Where is that?
Again, that's administration. And again, you could put that straight in as you're doing it and not do that working, if you wanted to do it that way. Alright, so I'm not sure if I explained this depreciation one very well the last day, so we'll go again at it. Most of the process of this is the same as all of the other depreciations that you've seen. So the first job is delivery vans. Find out what the delivery vans is. Alright, so during the year, a van which cost 25,000 was traded in against a new van costing 40,000. So delivery vans started off as always that cost figure. So delivery vans at cost is 155. It's not the 120, so it's the 155. Minus the old van, so minus the one you've traded in and add on the one you've bought. So it cost 25,000 and was traded in against a new van costing 40. Don't mind the 14,000 there for the time being. So 25 taken away plus 40. That'll be 170. All right. So what's it say about the depreciation? So a full year's depreciation is to be charged in the year of acquisition and none in the year of disposal. So you're not depreciating by month, you're just depreciating as it is. So the depreciation charge, it's going to be, what's the rate? What is it, 10%? 20%, oh yeah, sorry, where we got that from? You can't see it there, it doesn't give a percentage, but it's over 5 years, so every 1/5 is 20%. So it's going to be 20% of, so we're charging a full year's depreciation in the year of acquisition and none in the year of disposal. We're not depreciating this 25,000 at all. So we've gotten rid of it. So there's no depreciation on that, but there's a full depreciation on 140. So what's that leaving us? 20% of 170, isn't it? Yeah? And it's 20% of 95% of 170. Okay, because there's a scrap value of 5%. So it only ever goes down to 95% of the 170,000. Does that make sense? So that's 32,300. Right, so that's different than the other depreciation workings. There's no months given, so you can't depreciate by month. So you just have to follow the instructions that they have given to us. All right. The accumulated depreciation then. So it starts off as the difference between 155 and 120, so 35,000. Add on the charge for this year, which is 32.3. Then we're going to take away 20%. So the depreciation on the old van, 20% of 25,000 by the number of years you had it for. So nothing this year, and 20% of 95% of 25,000. And then we're going to multiply that by the number of years we had it for. So you bought it in 2016. We're selling it in 2018. And there's no depreciation on it in the year of disposal. Is that right? So a full year in the year of acquisition, none in the year of disposal. So full year in 2016, a full year in 2017, and none in 2018. All right? So there's 2 years depreciation. So it's 20% of 95% of 25,000. That'll give you 1 year. And then multiply your answer by 2. I'm just going to keep it as 24/12 for the time being, because that's the way it will be written in all of our other answers. So that will be 9,500 to take away. Okay, so I might have said to you the last day it was 3 years, did I? If I did, I apologize. So we're going to take away the 9,500. So that's your accumulated depreciation then now. Is that all right? At the end of this class, lads, I'm going to give you time to do that working again yourselves and see if you can do it that way. Then it says, obviously after the accumulated depreciation, it's profit or loss on the sale. So the value of the thing was the new van minus the allowance, so 25,000 minus 9.5, which is 15.5. And we got an allowance of 14,000. So it was traded in for 14,000. So we got 14,000 for something worth 15.5. So that's a €1,500 loss. All right. So check for the net amount is included in purchases. So the check for the net amount is the new van minus the allowance. So the new van was 40,000, the allowance 14. So the check for the new amount is 26,000. All right, so 26,000 has to be taken out of purchases. Okay. So it might have appeared tricky, but it's not too difficult if you just work through it as it's written to you. So that's that one. Number 4 then. It was discovered that goods have been sent to a customer on a sale or return basis. These goods have been entered in the books as a credit sale of 7,500, which is markup and cost 20%. So, based on the accruals concept, where you can only account for profits as they happen, so you account for losses as you predict them to happen, but you're not allowed to book profits until they actually happen. Sale or return basis means you have to assume the transaction is going to be returned. So, sale or return basis, the transaction has never taken place. All right, so sales. We've marked it as a credit sale of 7,500. So we've included 7,500 in sales. We need to take it out of sales as if it's never happened. So 1590, and we're going to take away that 7,500. That will be the only change to sales. Okay, we're going to do the same with debtors. So you sell goods to debtors at the selling price. We've included it as a credit sale, so which means it's also gone into debtors. That whole double entry bookkeeping system, they have to go in twice. So debtors is 98.2, and we're going to take away the 7,500. All right. The last thing we have to change is, and this is one of only, there's 3 workings that can affect stock. This is one of them. We still own the stock. It was on a sale or return basis at the end of the year. So basically the reason why they're saying it's at the end of the year is that the goods would not have been on our warehouse at the end of the year when the stock was counted. Okay, so even though we still own them. So we have to assume that they're going to be returned to us. So they should be in our warehouse. So we have to include them in our stock figure. All right, you value stock at the lower of cost or value. So you don't include stock at the 7,500. You include it at the cost price, which is 7,500 divided by 120 multiplied by 100. All right, because it's a markup of 20%. So I don't know what that'll be. Just check what that'll be. So minus 75 divided by 120 multiplied by 100. So it's 6250. So the stocks are always at cost price. Purchases and creditors are always at cost price, and sales is always at selling price. Just be aware of that. So if we buy goods, we buy at cost price. So if it gives us the selling price, we always have to work back to the cost price. When we sell goods, we always sell at the selling price. So you use the figure that's given to you. Is that all right? I did it the last day for you as well. Number 5, patents are written off over a 5-year period commencing in 2018. So there's nothing about investment income in this one. Yeah, Tara?
Do you take that 625 all the way?
Yeah, oh sorry, we added on. Apologies. Thanks, Tara. That would have not worked out. Yeah, because you own the stock. So yeah, you add it back on. Patents are written off over a 5-year period, so there's no investment income. So it's just the patents part, right? So patents and patents written off. I'll just do patents written off first, actually. So normally I do patents and then patents written off. So patents are, they do include 5 months investment income. All right, so it's just written in a different way. So I have to go back and do my investment income working. So even though they've written it differently, you go up and you look at the patents and you see that it includes investment income. Well, then you have to follow the way we've shown you how to do the patents working all the time. So 3% investments first to the fourth. So investment income is going to be 3% of 360. You got them on the first to the fourth, so you have them for 9 months. So by 9/12. So the investment income will be 8,100. That'll be your starting point for investment income due. We're going to take away 5 months, so it's 5/9, because you only have them for 9 months. So minus 81 by 5/9. You understand why it's not 12 months there? You don't own the investments for 12 months. So it's 4,500 you've received. All right, that gets added on to your patents. So the 4.5 gets added on to the 43.5. So that's 48,000. And then patents written off. What was it, over 5 years, I think? Yeah, 5-year period. So it's 9.6, which needs to get taken away. So that's 38,400. So I'm hoping that one's okay. It's a bloody lot of workings in this question. Looking at it. That one all right yet? All right, the next one then, the suspense figure arises as a result of an incorrect figure for debenture interest. Uh-oh. For debenture interest, so we do the debenture interest one first. Oh God. What the hell? I better not have deleted everything there. That's all right. So the debenture interest, go up and look at the debentures. Again, this is a longish one. 7% including 60,000 issued on the 1st to the 4th. So for the first 3 months we don't have that 60,000. So it's 7% of 240. And that's by 4/12. Sorry, by 3/12. And then it's 7% of 300,000 by 9/12. So in total that's 19,950. Now it's quite likely that it's this 4,200 that's wrong. Alright, so the first 3 months is 4,200. If we go up and find, it should be, I'm hoping it's debenture interest for the first 3 months. It is, yeah, so they have that 6,400. My number's right there. 7% of 240. Anyway, they have it at 6.4. So the difference between 6.4 and 4.2 is 2,200. So this number has to go down to 4,200. So we're taking 2,200 away from this, which means this side is too small by 2,200. All right. So if we've made this number 4,200, we've credited, we've taken 2,200 away from there, which means we're going to have to add on 2,200 to whatever incorporates suspense. All right, so salaries and general expenses, 243,100. And we're going to add on the 2,200. That means that the thing still balances now. All right. Second part then. Where is it? Discount received entered only in the creditor's account. Discount received should also be entered in the discount account. So it's always it'll always be creditors and discount or debtors and discount. So when it's entered only in the discount account, if it says it's credited, or if it's entered only in the creditor's account, you credit discount. If it's entered only in the debtor's account, you debit discount. So if we look at discount, it's 15.5 of a credit. if we're going to credit that, we're going to add it on. Do you get me? So if that was a debit and you're crediting a debit, you take it away. But if we're crediting a credit, we're going to add it on. So it was a discount of 460. So we'll add it on to there. And that'll mean that this side here now is 460 bigger than this side. So to make it equal, we're going to have to add 460 onto whatever incorporates suspense. So and it's 460 added on to salaries and general expenses. You'll find it's nearly always added on. In nearly every question, both of them are nearly always added on. They don't have to be, but they nearly always are. So if you're unsure what to do, just add them on. By what? No, in the suspense one I don't. So in the number that incorporates suspense, it's nearly always added on. Okay, so the 243 100. Is that all right? So we move on then. All right, the company revalued land and buildings 975. The land element of the new value is 150. Of this new value is 150. The revaluation has yet to be included. So buildings are depreciated at the rate of 2% of cost per annum. Jesus, right. So do the depreciation first. I'll have to check the answer to this, but you pretty much always, I don't know why they've written it so strangely, but you'll do the depreciation always before the revaluation. So we've got depreciation of buildings, and it's going to be 2% of, now the land is 150, so we have to take 50 out of 8, we have to take 150 out of the 850, so it's 2% of 850 minus 150. So it's 2% of 700,000, which is 14,000. All right. And instead of a revaluation reserve, let's make it a little bit smaller. Instead of accumulated depreciation, you're going to have revaluation reserve. So the revaluation reserve is the increase in land and buildings. So land and buildings has gone from 850 up to 975. No. Oh, sorry. I apologise. I didn't read it. That was my only problem. That was pretty bad. So that makes it a difficult enough question, actually. Just undo what I've done there. All right, so you have to basically revalue. It says they were revalued at the start of the year. So you have to sort of do the revaluation reserve here first. This year's depreciation doesn't go in because you depreciate at the end of the year. So the revaluation reserve, land and buildings are going from 850 up to 975. Now it has been asked this way before. So that's an increase of 125 in the revaluation reserve. You also then have to include the accumulated depreciation of 55,000 because the revaluation reserve is the increase plus the total depreciation. All right, so the revaluation reserve is 180,000. So you don't put in this year's depreciation because you always depreciate at the end of the year, and they're asking us to revalue at the start of the year, but that the revaluation hasn't been included. I would definitely got that wrong in my leaving cert because I would have rushed it and just done it the way it normally was done. Okay, the depreciation then. So now we will have depreciation. So depreciation of buildings is 2% of 975 minus the land is worth 150, isn't it? So you take out the land, so it's 2% of 825. Which is 16,500, which then, because you've started your depreciation again, you've an accumulated depreciation. It goes from 0 to 16.5, which is another 16.5. Okay, it's a bit like the club accounts where you've never depreciated before. So because you revalue at the start of the year, you do have depreciation and accumulated depreciation at the end of the year. I can see why I only had a couple of H1s that year. It's a tough old question. Does everyone understand that? I can look back at it later anyway. So, the bank working then. So we've got our two figures. We're saying that bank starts off as minus 60,000. The banker saying bank starts off as minus 62.8. But if that's it, and there is questions where it says debit, so sometimes it'll say the banker saying there's money in the bank, and you'll have to take that account as being plus. So it is possible that one is plus and one is minus. Alright, so we go through it. Check received from a debtor of 5.6 has been dishonoured by the bank. So we've seen this working before, not necessarily in this context. But in our figures, we have a check for 5,600. The debtor has been declared bankrupt and made a credit transfer for a first and final payment of 30 cents in the euro. So included in the bank is 5,600 in our figures. So we have to take it out. The bank haven't put it in their figures. So then what's happened after that? Check we received a check we received from a debtor for 5.6. So we've put it into our accounts as plus 5,600. So to get rid of it, you have to take it away again. You get me? Now, where else does that come out of? If we've received a check for 5,600, debtors, so they owed us 5,600, didn't they? So we're going to add that back onto debtors. That deals with that. That's the first part. Okay? The second part is that they have sent us a check or a credit transfer for a first and final payment of 30 cents for every euro owed. So they've now sent us 30% of the debt, so 30% of 5,600. So they've sent us 1680. Alright? So we've received 1680. Okay, so that was 30% of 5.6. That 1680 represents the full amount of the debt. So debtors go down by 5,600. So I know you've just put in plus 5.6 and now you're taking it out. It's really important you do it that way. So the check was dishonoured, so the amount goes back up by 5.6, and now the debt's been written off, so the debt goes down by 5.6 again. It's by the full amount. All right. The 1680 gets added back onto the bank, not to debtors. Debtors are people who owe us money. They don't owe us anything anymore. They owed us 5.6. We've written off the debt, so they don't owe us that 5.6 anymore. And then the difference between the two numbers is what? It's bad debt written off, isn't it? So it's the difference between the 5.600 and the 1680. So So it's 3920. So a direct debit to a local refuse company for 860 had not been recorded in our books. So what's that going to do to our bank figure? It's going to go down, isn't it, by 860? Now, it has to go somewhere else. So it has to go on our expenses somewhere. So it's not... which of the expenses do you think it might go in? I'd put it in salaries and general expenses. There's no refuse anywhere, is there? So it's just a general expense. So we can say our general expense of have to go up by 860. If I can find my general expenses, oh, there, salaries and general expenses. Okay. And then a check issued to a supplier for 2.5 had not been presented for payment, so hopefully these things balance now. And they do. They don't. 280, that should have been 62, 280. Now they do. Okay, so that's our bank one done. Again, if you did your leaving cert that year, you wouldn't have seen those workings in those contexts before. So you wouldn't have seen the check received from a debtor of 5.6 being dishonoured by the bank. It's just understanding that you have to deal with that and then deal with the second part secondly. So if you just think calmly about it, you won't get that one wrong. And what's more, you will have seen this question before. We go and do the next topic we do is tabular statements, and it comes up in tabular statements all the time. So it's our ability, can we transfer over that information from one question to another? All right. The last one then, provision to be made for both debenture interest and investment income due. We've done both of those. So provision for bad debts to be adjusted to 4% of debtors. So it's 4% of the new debtors figure. So I'll go back and work that out. So it's 4% of 90,700. Which is 3,628. Every time we have bad debt provision, we have a change in bad debt provision. So go and see what the original figure was. Bad debt provision is 4,000, so it's a decrease in bad debt provision. So it's gone from 4,000 to 3,628, which is 372 decrease. So it's important we note that it's a decrease. If it's an increase, it's in a different place. The managing director should be paid a bonus of 5% of all sales in excess of 1.2 million. I looked at the American scheme for the last question. Remember, I did that slightly wrong, so I have it right in the video I did. Actually, in the American scheme, it says you can do it either way in the notes to the American scheme, but I've done it the way it is in the American scheme now, but you can have a look back at that yourselves. Anyway, sales, 5% of sales over 1.2 million. It's not of the sales figure in the question, it's the sales figure in the working. So sales changed in the working. So sales is 1,582,500. So that's an increase of 382.5. which is 19,125. That will also be commission due, which is a liability. So again, I wouldn't necessarily write that down. I'll just put it into current liabilities. So it should be paid a bonus, so they haven't been paid the bonus. Transfer of 10,000 should be made from profit to the capital reserve. So this has been a new thing. It was in the last question as well. So if you look here, capital reserve is 45,000. We're going to increase that by 10,000. 45,000 plus 10,000. And all we're going to do is we're going to reduce our profit and loss balance by 10,000. So profit and loss balance, I don't know why they've done this, because it makes absolutely no difference to the answer or to the question or to the accounts, but profit and loss balance on the 1st of the 1st was 71.5, and we're going to take away 10,000 away from that. Okay, and that's 61.5. So we've just moved it from one reserve to another. A capital reserve goes into finance by. Okay, so I'll go through where everything goes, then I'm going to stop this video because we'll go on way too long otherwise. So we label where everything goes. So closing stocks, obviously trading and the current assets. Purchases is in the trading account. Insurance claim due is a current asset. Loss on the insurance claim, what did I say that was? Admin, yeah. Delivery vans is fixed assets. Depreciation of delivery vans is selling and distribution. The accumulated depreciation will go into fixed assets as a minus. Profit and loss on the sale, so it's a loss, isn't it? So the loss on the sale of the van is selling and distribution. If it was a profit, it will be other operating income. Sales goes into trading. Debtors is a current asset. Investment income goes in its own spot. Investment income due is a current asset. Patents is a fixed asset, an intangible fixed asset. Patents written off is admin. Debenture interest goes in its own spot. I actually didn't work out debenture interest due. Debenture interest due is going to be this 15,750. All right. Because if you've paid 4,200 out of 19,950, it means you're still due to pay the 15,750. Salaries and general expenses is admin. Discount, it's discount net, it's credit. So it's a credit discount is other operating income. All reserves are financed by, so the revaluation reserve is financed by. Land and buildings is a fixed asset. Depreciation of buildings, admin. Accumulated depreciation will go into fixed assets. Banks, current liability. Bad debt written off is a selling expense. The bad debt provision goes in current assets with debtors. So it's sort of minus debtors. A decrease in bad debt provision is another operating income. And the commission is an expense. So it's a selling expense. And the commission due is a current liability. All right, this capital and reserves is financed by, and all you have to remember is the profit and loss balance has changed. I would change it in the question there, so I'd cross out the 71.5 and write 61.5. Yeah.
Where does the decrease in bad debt provision go?
Decrease in bad debt provision is other operating income. So from the question itself, then. Land and buildings we've done, accumulated depreciation we've done, delivery vans we've done, discount we've done, profit and loss we've done, stock on hand, that's your opening stocks, that's trading. Debenture interest we've done. Investments are a fixed asset. Dividends paid just go in the the dividend section of the trading profit and loss account. Debtors and creditors, have we changed both of them? We haven't changed creditors. So creditors is a current liability. Bank we've changed. Salaries we've changed. Debentures goes in finance by, as does issued share capital. VAT is a credit, so if VAT is a credit, it's a current liability. And advertising is a selling expense. Any of them we're not sure of? I'm just going to stop this video now, lads, and I'm going to get you to do the rest of the question.